Welcome to The Explainer. Today, we're going to demystify a concept that honestly sounds pretty intimidating, but it's actually the core mechanism behind how everyday traders wield some serious market influence. We're talking about leverage and margin. It's a genuinely fascinating topic, so let's just jump right in.
Think about this for a second. How do you control an absolute fortune when you literally only have pocket change to your name? Okay, let's dive into this. Because having financial super strength, it's not just a fantasy in the trading world. It's a fundamental mechanism built right into the system. And once you understand it, it kind of changes everything about how you view the financial markets.
Section 1. The magic financial lever, lifting boulders with ease. So imagine standing in front of a massive 1-ton stone boulder, right? You can't push it, and you certainly can't lift it with your bare hands. No way. But if you have a long enough metal bar, a lever, and a really solid pivot point, you can move that massive rock with just the gentle push of one hand. Well, financial leverage is exactly the same concept, just applied to money instead of stone. Basically, leverage is controlling a large position with a small amount of capital. Just like that physical lever, you're using a tiny bit of your own effort, in this case, your own capital, to move a massive financial boulder. You're essentially making your money punch way, way above its weight class.
Let's move to Section 2 and see how this builds. Decoding leverage ratios, the math behind the magic.
All right, we've talked about the big picture concept, but to really grasp this, we need to look at the actual numbers used in everyday trading to make this financial magic happen. Out in the markets, you're going to constantly see common leverage ratios like 1 to 30, or even an incredible 1 to 100. I mean, just think about the sheer scale of that multiplication for a second. For every single dollar you put down, you are suddenly commanding $30 or a staggering $100 out there in the live market. Your purchasing power is instantly massively magnified. Now, what's really interesting about this slide is how clearly it breaks down that 1 to 100 ratio. Look at that tiny slice, just 1%. That's your capital. That is the pocket change we talked about earlier. And yet, because of leverage, it completely controls that massive 99% chunk, which is capital actually provided by your broker. You are directing the whole pie, but you only had to pay for a tiny crumb of the crust. Pretty wild, right? Moving on to Section 3, the initial margin down payment, getting the keys to the trade. Because, let's be realistic here, a broker isn't just going to hand you 99% of the money for free without some kind of security deposit. And that brings us to initial margin, which is exactly what you put up to open the position. It's your skin in the game. Before the broker lets you borrow their capital to swing a massive trade, they absolutely need you to lock away a specific amount of your own money first.
And this brilliantly illustrates the concept. Think of buying a house. In the real world, you don't pay the full $500,000 up front, right? You put down a 10% deposit to get the keys and control the entire property. Well, in the trading world, that exact same concept is your initial margin. You're handing over a small security deposit to get the keys to a massive financial property.
Section 4. The maintenance margin trap, keeping the house in order. But getting those keys isn't the end of the story. You have an ongoing and sometimes hidden responsibility called maintenance margin. Simply put, this is what you must keep to hold the position. And frankly, this is the exact spot where so many enthusiastic beginners get caught totally off guard. If initial margin is the down payment to get into the house, maintenance margin is like proving to the bank that you still have enough cash on hand to fix the roof if a bad storm hits. If your overall account value drops below this required upkeep line, well, the broker steps in aggressively to protect their money. Let's walk through the chronological life cycle of how this can go wrong. Step 1. You put up your initial margin and open a big trade. Awesome, you're in the market. Step 2, unfortunately, the market shifts and the trade goes against you, so your tiny 1% slice starts taking damage. Step 3, your account value drops so low you actually hit the maintenance margin limit. And Step 4, you either add more funds immediately or the broker liquidates your position, meaning they force sell it to protect themselves. You know, it's almost like a landlord suddenly banging on your door and demanding extra rent right this second just because property values slightly dipped. If you don't pay up, you're evicted from the trade. Which brings us to Section 5, the double-edged sword. Magnified profits, magnified ruin. Okay, up until now, leverage has sounded like a phenomenal superpower, but we really need to take a serious, cautious look at the reality of wielding this kind of market influence. Think back to that 100 times multiplier. So the crucial point is that while a lever makes moving a giant boulder incredibly easy, if you lose your grip, That massive, 100 times heavier boulder can easily roll right backward and completely crush you and your little lever. Here is the core warning. Leverage magnifies profits, yes, but it absolutely magnifies losses too. The math simply does not care which way the market goes. It works exactly the same in both directions. If a 1% move in your favor means you double your money, a 1% move against you means your entire initial margin is completely wiped out in the blink of an eye.
So always remember this absolute golden rule of margin trading. Leverage magnifies both profits and losses. It's a simple sentence, but it dictates absolutely everything. Having market power is a fantastic tool for building wealth, sure, but it requires deep respect, clear strategy, and absolute discipline. Which leaves us with the ultimate question for you to consider regarding your own personal risk appetite. When you step into the market and look at that powerful financial lever, you have to ask yourself, is the potential for magnified reward truly worth the risk of magnified ruin? Thank you so much for joining me for this explainer. I hope this gave you a crystal clear understanding of market mechanics, and I will catch you next time.